Treasury companies are effectively monetizing the capital appreciation of Bitcoin and using very sophisticated capital structure engineering, whereas we are trying to generate an underlying yield on that Bitcoin. Most of these companies, as yet, are not actually generating a yield on the underlying asset. Once an institution or a person comes in and buys Bitcoin, they think of two things. How do I use it, like borrow against it? Or how do I get a yield on it and what can I do with it? I've got Bitcoin, a bunch of my peers have Bitcoin. How do I outperform my peers? Well, I can do that if...
This episode of Supply Shock is brought to you by Ledn, a proud Bitcoin-only company and the global leader in Bitcoin-backed lending. Need cash but don't want to sell down your Bitcoin stack? Ledn has a trusted track record in providing liquidity. That's Ledn. You'll hear more about them later in this episode. As always, investments in blockchain technology involve risk. Terms and conditions may apply. Do your own research. Quick reminder, nothing said on Supply Shock is a recommendation to buy or sell any investment or product. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hey everybody, Pete Rizzo, the Bitcoin historian on X, welcoming you today to a new episode of Supply Shock. We've got a great guest for you today, Maple Finance CEO Sidney Powell, who's going to talk to us a little bit about all that's happening in the race to earn on your Bitcoin. So essentially, the new meta narrative that is really kind of taking this cycle by storm is this idea that people now who own Bitcoin are looking for ways to outperform, whether that's tapping into sort of new novel crypto networks or wrapping their assets in things like Bitcoin treasuries and going public. It seems like everyone is trying to chase yield in some form. So Sidney, welcome to the podcast.
Thanks for having me on, Pete. Glad to be here.
Well, maybe we could just wind it back. Obviously the company is focused on, a mission here to try to get people with Bitcoin, some additional capital yield on that. Where did you identify that as sort of an issue that you wanted to tackle, and how did it become a startup?
It's a good question. I mean, initially Maple's path was that we were focused on credit and lending. And so we have in the past done institutional loans. Now our focus has been institutional loans against Bitcoin and other large cap assets. And so naturally the evolution for us has been towards on-chain asset management. So that's kind of how we describe Maple now. And the two questions you often get, like once an institution buys Bitcoin, the two things they care about are what can they do with it? Can they borrow against it? Or earn a yield through lending against it. And the other thing is, how do they get a yield on the Bitcoin? And so we'd been thinking since, probably since like mid to late last year, how do we provide a product that taps into that huge market opportunity that we saw? And so we now have a partnership. So we have a Bitcoin yield product done in partnership with CoreDAO, which uses staking to provide a yield for institutions. And we launched that earlier in the year, and it's now got, about 150 to 180 million in there. But that was kind of our first foray into how do we provide Bitcoin yield to these institutional clients.
Yeah, well, obviously a lot of ways that this is happening now, and wanted to start with the traditional financial layer because that's where the attention and focus is with everything that's happening in Washington. It does feel like Wall Street is now coming to Bitcoin and crypto, and that's happening in a number of different ways, some of them new, some of them familiar. So the one that we chatted about kind of as we prepared for this call the most was this idea that, these Bitcoin treasury companies, these sort of Bitcoin finance public companies, essentially you're having, a new emergent class of companies that are offering at least the promise that this is a way for you to, if not earn on your Bitcoin, at least outperform Bitcoin. Maybe you can talk a little bit about the similarities between what you're offering and what this class of companies is really pretending on.
Yeah, it's a good question, and the idea of outperforming Bitcoin is not necessarily a new one. I think it's just it's just we now have new vehicles for it. But whenever we speak to a lot of the venture funds or liquid funds out there, their benchmark is Bitcoin. So if they couldn't outperform Bitcoin, there'd be no point for their clients to pay them 2 and 20, or sometimes more than that. But the premise, uh, the premise now for these digital asset treasury companies, or DATs, as a lot of people are referring to them, is that it can be valuable. Why would you ever pay a premium to own a dollar of Bitcoin? So why would you ever pay more than a dollar, sometimes $2 or more, to own a dollar of Bitcoin? And the premise or the pitch has been these companies will compound your Bitcoin over time. So you might have paid $2 for $1 of Bitcoin, but in 10 years, maybe there's now, maybe you're now getting $2.50 of Bitcoin for what you previously paid $2 for. And the idea is that these companies are sophisticated at scale. They have better access to capital markets. And so they can raise money cheaply to purchase Bitcoin using creative structures. Saylor has really been the trailblazer here with pref equity, convertible bonds or convertible notes, and previously forms of secured lending. So he has about, at this stage, I'm going to get this number wrong, but I think it's about 5 layers of his capital structure. He has everything from Strife, Strike, to right down to common equity. But what he's done is he's been able to segment Strategy's balance sheet and capital structure to sell different products to different institutional investors. The Probably the best known example was the convertible bonds, where they were effectively sold to convertible debt investors because they had a lower or rather a lower implied volatility than what they really did in the market, and so they looked really cheap to those players, and it gave Saylor a war chest to go out and buy more Bitcoin. So that's the traditional vehicle, and if I contrast it to what we are doing and what others in the DeFi space are doing, we're using a different kind of underlying mechanism to generate the yield, or to generate the return. So I think the core difference, if you boil it down to it, is most of these companies as yet are not actually generating a yield on the underlying asset, which is their Bitcoin stockpile. They are instead tranching out their capital structure to generate returns for their investors, and the ultimate return just comes from the appreciation of Bitcoin or the volatility therein. Whereas for us, we've had to take it to a kind of a more fundamental level, which is we actually need to generate a return on the Bitcoin. And there's 4 ways you can do this, Pete. The 4 ways are: you can either lend it, and so you're taking counterparty risk. Somebody borrows your Bitcoin, does something with it, and pays you interest for the privilege. The other way you can do it is volatility trading. So you try and uh, you know not time the market, but you're trying to effectively monetize the volatility of Bitcoin while still having the same overall number of Bitcoin. And then the other 2 ways are that you can stake it. And this is what we've done in partnership with CoreDAO. So we're effectively validating the core network. And to do this, we need Bitcoin and core tokens, and we generate a yield, which we show our clients in Bitcoin. And then the other way that you can do this is by selling covered calls, which is, in essence, you're giving up the upside of future appreciation of Bitcoin in exchange for generating a yield now by selling options. So I know that was kind of a lot to unpack, but the core essence is the treasury companies are effectively monetizing the capital appreciation of Bitcoin and using very sophisticated capital structure engineering, whereas we are trying to generate an underlying yield on that Bitcoin.
Right. So the difference here, I think, maybe simply is that the Bitcoin yield, that when you're talking about Bitcoin treasury companies, and the sort of yield that you would get from just having a service and customers sort of paying, whether if it's borrowing or lending, they're sort of paying some continued interest rate. These are not the same things. They're offering you, maybe as an end user, exposure to some sort of additional Bitcoin earnings, but they're actually coming from a different place, and they have different risks.
Yeah, that's absolutely right. So different risks. And in our case, what we're trying to do is we're offering more of one simplified product, which is, in Maple's case, you lend us your Bitcoin, we stake it, and then we give you a yield back in Bitcoin. And what we do on the back end is we manage the staking operations and infrastructure, which isn't trivial, and then we hedge out the risks. So we mitigate the market risk and the counterparty risk, And so for you, it looks like a simple product. You lent us your Bitcoin, so it wasn't a taxable disposal. It's held in custodians, and then we give you back Bitcoin yield. We're not giving you back yield in points, other tokens. It just comes back in Bitcoin. And so a lot of OG Bitcoin holders and institutions have liked the product because they can also do it in native Bitcoin. They don't have to do complex, uh, interact with smart contracts or
Whereas, and maybe with the contracts with the treasury companies, you're putting the Bitcoin, you're buying the equity shares, right? So if you are putting Bitcoin into these companies, you're maybe even investing, you're likely doing that into some sort of conversion into dollars, and there's some tax implications with that, correct?
Yeah, I think if you were to subscribe for a fund in Bitcoin, often it's treated as a disposal, and so you will incur capital gains on that. I think it's definitely worth noting, one of the appeals of becoming I'll call it a private side investor in one of these Bitcoin treasury companies, is that if you do the pipe, or if you do uh, the converts, some other subscription for it, often what you're able to do is subscribe in Bitcoin. This is what Tether's done with 21. This is what others have done with the more recent ETH vehicles. And so what you're doing there is you're getting the optionality that in the near term, it's kind of unlikely that you're going to trade at a massive discount to the value of your Bitcoin. So effectively, what you've been able to do is take, the one Bitcoin that you had and effectively get a markup on it of, two, three, sometimes a higher multiple on that. So you've been able to um, you've been able to effectively turn what was $1 of Bitcoin into $3 of assets there. And I think that's a big appeal from a tax efficiency perspective.
Yeah, and as I talked to the proponents of the Bitcoin treasury model, really what they've tried to say, and this is probably best summarized by Pierre Richard, who had a tweet yesterday, which is, securitization, not tokenization. And sort of his, lens on it is essentially, this process of securitization, doing what Michael Saylor has done, by breaking out these different tranches, is sort of known. This is accepted by Wall Street. They understand the risks with something like that. Whereas tokenization, and that's maybe what you're talking about here with putting your Bitcoin into some sort of wrapper, doing some additional, rely on additional cryptocurrency structure. It seems like what they're saying is that they don't see a world in which Wall Street sort of becomes comfortable with that, or at least maybe that they see that the securitization is more comfortable for these traditional institutions to begin. What's your take on that view? They call it the hodler's dilemma. Ever wish you could get access to cash without selling down your stack? Well, Ledn makes that possible. Since 2018, Ledn has issued over $9 billion worth of Bitcoin-backed loans, and they haven't lost a single satoshi of client funds in the process. There are no credit checks. You can get funds in under 12 hours and repay whenever you want with zero penalties. Unlike others, Ledn doesn't lend out your collateral. They even publish biannual proof of reserves verified by top auditors in the blockchain. You can learn more at ledn.io. That's ledn.io. As always, investments in blockchain technology involve risk. Terms and conditions may apply. Do your own research.
Yeah, I don't disagree with the take. In the near term, I think over the long term, Wall Street will become more comfortable with tokenization because that's kind of what we're hearing from folks at BlackRock and others. But I think in the near term, it's definitely been it's definitely been a shorter sales cycle to sell Wall Street on instruments they're already familiar with, where you're effectively, what you've done is you've securitized the volatility of Bitcoin, right? Like at times, MicroStrategy or now Strategy was trading their shares had more volatility than Bitcoin, and so when you structure a convert instrument, the convert instrument carries a lot of value for hedge fund buyers because uh, you have the value, the embedded value of the option, or the value of the embedded option, which is higher the more volatile a stock is. That's why Strategy was such a great pick to put into converts. It's easy for the Wall Street analysts because they analyze it in the same way, right? They just look at what was the historical volatility of the equity price of MicroStrategy. Whereas I think the issue that a lot of people have found with tokenization is what they've tried to do is take a traditional instrument and then sell it to a crypto native investor. And crypto native investors have shorter time preferences. They have higher return hurdles and higher opportunity costs because that's why they're in the space. They came into the space for higher returns and to kind of be at the bleeding edge of technology. I don't think it's been a great success story so far, packaging TradFi products and trying to sell them to crypto investors.
Yeah, I think one of the broader things here is that, by and large, it seems like Bitcoin investor, older Bitcoin investors are now, at least from the ones that I know, I know a lot of Bitcoin investors who've been in the space for over 10 plus years. They seem more comfortable now, especially as Wall Street is getting involved, testing out some of these products, whether it's the pipes that you talked about, getting into these treasury companies early. But now it sort of seems that it's just opened up this option field. So I guess like the question is, who's the target market for a Maple Finance? Do you feel like these are both products that ultimately are appealing to crypto natives or Wall Street, or a combination of both, or how do you see the target markets? I know we're using this analogy, I think, because certain market participants, might have this lens, but I don't think all market participants have this lens. So I was wondering if you could break that down.
I think what we've tried to do is initially sell our products to crypto native people. I think it's been what we've seen is that the folks who have tried to sell the crypto products to traditional investors aren't making many sales, and so they're needing to try different strategies. What we said is let's begin with penetrating the crypto native market, and so we have our stablecoin yield product where you can get dollar yield lending against Bitcoin, ETH, Sol, like large caps, stuff people have been comfortable with. And that has been an easy sell because the product has existed for a number of years. Crypto native investors are very familiar with it. My longer term view is that this product is actually going to be very saleable to traditional investors in time because Bitcoin is being more accepted as collateral and an asset that belongs in everyday portfolios. You see people like Ray Dalio saying people should have 15% of their portfolio in Bitcoin and gold. So it's becoming more accepted as collateral. And I think that insurance companies, pension funds, and endowments will like the fact that you can get a source of yield which is over collateralized, short duration, and it gives you an extra 2 to 4% above money market funds. But this is the key component. They can't go and get that from Morgan Stanley at the moment. So there's no place to go and buy that exposure except us. I think we have one of the only kind of investable forms of that asset class. And that's why that's how we've tried to differentiate ourselves. And that's the path we see to selling that to traditional investors. And then you've got our crypto, like the Bitcoin yield product, which again, we've begun by selling that to, OG Bitcoin holders, high net worths, family offices who hold Bitcoin. But the next stage of selling that is going to be to institutions who have bought Bitcoin in the last 1 to 2 years and who now want to get a yield on that asset. Treasury asset company, like the digital asset treasury companies, I think will have to compete with each other. And one of the ways they'll compete with each other is not going to be by raising a larger and larger treasury. I think that game or that race has kind of been won already in a sense by Saylor and Strategy, but it's going to be by can they efficiently get a yield on their Bitcoin, and so I think they're going to be customers as well down the line.
Yeah, at least on the pipe side, I'm struck by mentioned kind of high net worth OG Bitcoin investors. They seem a bit more comfortable with the securitization risk than the technology risk. And that's where Maple maybe comes in, right? And you're trying to obfuscate that a little bit, right? You're taking this Bitcoin, you're putting it into more exotic kind of L2 products. But there's still an aversion to one, the technology risk, and then using something that's not native Bitcoin that maybe is, an extension protocol, which is, maybe hasn't had the sophistication and the testing. In a lot of cases, these L2s, maybe a year or two old. How do you talk through customers about that risk?
I think you're definitely correct. It's a blocker that we do get from longer term Bitcoin holders, and I think some of the ways we've tried to tailor the product to suit them have been there's no slashing, so their Bitcoin can't get slashed. It sits in a custodian. So it's not, I think a lot of them take a higher degree of comfort knowing that it's not sitting in a smart contract somewhere. And then the yield is ultimately paid out in Bitcoin. So for them, it looks like they transfer their Bitcoin to us as a loan, and then they receive, monthly statements, or they can log in and see it in the front end, but they're receiving their yield in Bitcoin. We're not giving it to them in magical internet money, which a lot of them are skeptical of. That being said, there's still a natural aversion, as you said, to the technology. A lot of them, they have generated their wealth by being staunch supporters of Bitcoin and long-term believers. And so, they're naturally skeptical, and with good reason, of some of these newer technologies. So I don't know that in the end result this is kind of our real target customer, because they like the simplicity of just holding Bitcoin. And I think for those types of investors, the securitization structure is very good, because they're actually just banking on future appreciation of Bitcoin. And what Saylor and some of these other companies are doing is just giving them a way to effectively lever that up and accumulate more Bitcoin per share over time. Our core customer in the next couple of years is going to be people who have purchased Bitcoin in the last 1 to 2 years, who are more comfortable with the concept of, Bitcoin L1s and L2s and DeFi products. Like, I think they're just going to be, because they're newer to the space, they're going to have less of the hangups.
So you almost see this as like a newer emerging customer set of people who are maybe crypto native pro Bitcoin. They want to hold Bitcoin the asset, but their experience hasn't been shaped by more of kind of the old time Bitcoiners, which had a more kind of purity of vision in terms of how they want the technology stack to progress. Is that correct?
And there's this, I think that's right, but it's also worth noting there's a survivorship bias in the people who hold, who hold a lot of their wealth in Bitcoin, who have held it for, 5 or more than 5, let's say like 10 years. Is These were the people who opted not to subscribe for ICOs with their Bitcoin, or opted not to put it into Celsius, and opted not to put it into smart contracts that got hacked. And that's what kind of kept them wealthy. And so, they're, like I said, there's kind of a natural survivorship bias where they're naturally going to be skeptical. Whereas the newer ones, they don't have those hangups. They don't have a ton of uh, like unrealized gains built into the Bitcoin. They haven't been holding it for 5 to 10 years. And particularly newer institutions, like some of them might have added Bitcoin in the last, you know 12 months to their balance sheet, and they're looking at it going, okay, I've got Bitcoin, a bunch of my peers have Bitcoin. How do I outperform my peers? Well, I can do that if I can earn a yield on the Bitcoin. And so there's going to be natural competition between institutional investors, and I think those will be our customers.
Yeah, very interesting. An interesting thing that about that risk profile. So as you think about your products, you're trying to obfuscate a little bit of the technical risk, but obviously you have to have a high degree of understanding of the technical risk of the different protocols and L2s. How do you see the Bitcoin L2 landscape? Obviously, you have a specific partnership, and presume you have sort of a strong kind of bias towards that technical stack. But there's this group of teams. There's a few emergent technologies like BitVM and other sort of trust minimized constructions for how these blockchains will be set up. I mean, how are you looking at that space, and what are you saying?
If you look across the landscape at the moment at the different, call it Bitcoin L1s and L2s, the game is the same, which is they need to construct an ecosystem in order to make the yield that they're generating sustainable for their products. And so you have, just to name a few, definitely not exhaustive, but you have Babylon, you have Lombard, you have Solve BTC, you have Thesis, and and TBTC. And to varying degrees, they include trust minimization. I find trust minimization, it doesn't resonate too much with different clients that we talk to. They more
Well,
care.
now these are all multi-sig constructions, right? There's some sort of
Yes,
plurality of
there's usually some kind of multi-sig construction there. To varying degrees, they try and sell things like trust minimization, lower risk, like not having slashing. But in essence, what they need to do is kind of construct a workable, viable ecosystem that will have different financial products on there, um, or you know, uh, or they're selling security. So, like Babylon, restaking, you're primarily selling security to other chains, similar to what EigenLayer was trying to do on ETH. Whereas other ones like Core, for example, is trying to build an ecosystem where they have stablecoins and DeFi products and use that to generate the ultimate yield, which will be paid out to the Bitcoin validators. And then you have BOB, build on Bitcoin, BitVM. So there are a number there. I'd say it's still a pretty open race at the moment. I don't think there's been clear leaders emerge yet in terms of that construction of the ecosystem, though there are kind of clear leaders when it comes to TVL and size at the moment.
Yeah, maybe we can talk about the TVL, the size, and this race, and the clear leaders. I guess we saw a big presence from the Bitcoin L2s at Permissionless, the Blockhorse conference earlier this year. Obviously, we've got Digital Asset Summit coming up in October, out in London. Expecting the same. These are heavily capitalized startups. I'll go through the list of Hemi also being there. There's Munib Ali, of course, in his company. There's that is been building, right? Trust Machines, which has been out there. In terms of how they're competing, or how are you seeing them acquire applications? I mean, there hasn't been, and this was the subject of our conversation on stage, right? There hasn't been sort of a big winning app like a Polymarket on any of these, layer twos. Obviously, that's kind of what they're all expecting. Do you see that there's going to be an inflection point or a moment for this technology stack upcoming? Let's take a quick break to talk about today's sponsor, Ledn, the most trusted name in Bitcoin-backed lending. Look, if you're like me, you never really want to think about selling your Bitcoin. Ledn has a solution. You can borrow against your Bitcoin. No credit checks, no monthly payments, no hidden fees. You can get your cash in under 12 hours and pay back when you want with zero penalties. Unlike other platforms, Ledn has a history of transparency. They prove it with independent proof of reserves audits every 6 months on the blockchain. In total, they've issued more than $9 billion in loans without losing a single satoshi of client funds. That's the kind of track record you want when it comes to securing your Bitcoin. You can learn more. Visit ledn.io. That's ledn.io. As always, investments in blockchain technology involve risk. Terms and conditions may apply. Do your own research.
I think there will be, but it's tough to say who's going to have that inflection point. So you can either do it the bottom up way would be that you find a Polymarket or like a must-have app that kind of brings users to the ecosystem. And then the top-down way is that the ecosystem kind of, does various, in forms of incentivization. Let's say the foundation does various forms of incentivization to kind of bring some of the leading apps from other chains across, whether it's an Aave or us or stablecoins like Tether and USDC. And, each of those is just challenging. Like, I think we've seen a number of different ecosystems try and launch over the last 12 months, whether it's Chain that have tried novel, kind of consensus and incentivization mechanisms that have, that have had pretty rocky starts. And so, each of these Bitcoin ecosystems is trying to do the same thing. I think, we saw Babylon had something like 6 or 7 billion worth of Bitcoin locked in there. But similar to EigenLayer, it's been tough to find people who have been willing to effectively pay for what I would otherwise call catastrophe insurance from these restaking platforms. So I think we're kind of back to the drawing board of how do the ecosystems just bring stable coins and then other basic kind of DeFi primitives and then trading. I think one of the things Solana did really well was differentiate itself and kind of capitalize on the opportunity that came through with meme stocks. And you've seen that with things like Pump.fun, and other launch pads. That is where the majority of that activity happens. And I don't know if I had a crystal ball, I'd be a better investor, but I'm not sure which segment of the market is gonna kind of trigger that that Cambrian explosion on one of those chains.
Well, I think what I was trying to get at is obviously, your Bitcoin product, the way that it's structured, it seems like you're making a long-term bet on the survival of something here, right? That there is going to be some continued way for there to be some Bitcoin L2 that has a token-based incentive model that you can then use to kind of pass on that yield to customers. I guess, why are you long-term bullish on just that construction? Because that is this very specific design construction for how you could build Bitcoin in the future.
I think the reason I like that construction is that I think Bitcoin has a really big install base of users that is growing, and that as new users come into the crypto space, very often their first point of entry is Bitcoin. It has the longest history. It has the most institutional adoption, and people are the most comfortable with it from a risk perspective. So, I think the idea that you can have an ecosystem built off this kind of install base of Bitcoin users and holders is, I think it's a strong thesis, and I think there will be people for the reasons I mentioned. Earlier, once an institution or a person comes in and buys Bitcoin, they think of two things: how do I use it, like borrow against it, or how do I get a yield on it, and what can I do with it? And if you can take your Bitcoin, put it into one of these ecosystems, and then it gives you access to these other financial products, like Core is trying to do, and like some of the other Bitcoin L2s are trying to do, like I think that will lead to a strong user base over time. So that's the thesis I see playing out, is that people who have Bitcoin and people who are new to buying Bitcoin will be naturally aligned with an ecosystem that is kind of built off of Bitcoin.
Well, from the Bitcoin developer standpoint, right? I think they've made no bones about that they're sort of adversarial against some of these other token based systems where their long term goal is to try to bring this back to the native Bitcoin layer. We had the folks behind Arc on a couple of weeks ago talking about, building a system based on Lightning that would kind of obfuscate the need for additional tokens. I think to the extent that Ordinals was able to kind of get, if not majority of plurality mindshare within Bitcoin, a lot of that was the, structure of the product. So I guess how do you look at that potential risk? I mean, obviously Bitcoin developers have been unsuccessful at obfuscating all tokens, as obvious from a couple $1 billion of crypto market value that's still out there, but Bitcoin's still commanding 60%, and that dream is still alive. So I guess how do you look at that dream?
I think one of the challenges that's kind of presented with that this, when I've spoken with the core team in the past, this was one of the reasons they cited for creating it, is that in time there are going to be some issues with the security budget for Bitcoin as you get closer and closer to the end of the supply curve, and it becomes more expensive to mine Bitcoin, and the amount of revenue that miners get for securing the network, is declining, and you get higher barriers to entry to being a miner. I mean, already you've seen a lot of that industry consolidate, right? Like the bigger ones are getting bigger, whether it be a Marathon, and it's so cyclical that the weaker ones get shaken out every time you hit the kind of the bear market. And so I think that's a valid concern for the future security of the network and concentration of hash power.
Interesting. So I guess you very much see a situation where Bitcoin does have a long term security problem in your view.
Yeah, and I'm not necessarily a hard advocate to that thesis, but I am pointing out that the thesis is out there. I think it's a risk to be taken seriously, and I'm an entrepreneur, so I think about the opportunities presented there, and one of them I see is that you can have a Bitcoin DeFi ecosystem built off of the idea that you can generate staking returns and use that to give additional revenue to miners and other constituents in the Bitcoin ecosystem.
Yeah, I think the counter thesis that we hear a lot, especially, today, no exception, we're going to hear the US government kind of report on Bitcoin and crypto that, if you have a plurality of stakeholders in different governments, maybe you have multiple strategic Bitcoin reserves in many locations, maybe hard to see a scenario where Bitcoin mining doesn't continue simply because, there's so much confidence and investment in Bitcoin, the asset.
The really interesting aspect with Bitcoin mining is going to be if you see backwards vertical integration, where the Bitcoin miners effectively, like, one of the things I've always been interested in is, like, will it actually be the lowest cost energy producers that are the naturally dominant Bitcoin miners, like Saudi Aramco and others who have near kind of infinite supplies of energy. I don't dispute the thesis that you could see long term sustained mining activity, but I just have to think of the opportunities, and here I see an interesting opportunity where we can offer a Bitcoin yield product, which is actually being pulled out. It's being pulled out by the market in that there are a lot of people who have Bitcoin who are very interested in getting a yield on it. And so, could we create something? And in this case, we've done so in partnership with Core that meets that need from the market. It's been a tough problem to crack, and I think that's why you can see that there are people approaching it from a number of different angles, whether it be creating a Bitcoin L1 or L2, doing trading strategies, doing covered calls, or indeed going the securitization structure. But I would argue that with the securitization structure, it's unless you're in MSTR common equity, there aren't a lot of instruments that are just giving you, outright exposure to increasing Bitcoin accumulation.
Well, winding down a bit here, obviously, want to take a wider look at the ecosystem. A lot of people who are, coming to Blockwork these days, very new, maybe on the institutional side, looking to understand where they are in the opportunity curve. I think it seems pretty clear from maybe our discussion. You think Bitcoin's going to be around for a long haul. A multi-blockchain world, is that still something that you sort of see as, that's what we're moving to? And if you're an institution, what do you say to people who are looking to get building in the space?
It's an interesting question. I do see a multi-blockchain world, just because empirically that's kind of the way things have shaken out. But it's been interesting to see the specializations. Call it the debt capital markets are kind of very much happening on Ethereum, and then you have trading, like high frequency trading and meme coins and equities kind of happening on Solana, and then you have obviously a very rich Bitcoin chain ecosystem. So I think that will continue. I'm less of the opinion that every application needs to be on every chain. I think you can actually find your constituent users, and there's an advantage to kind of having your product or your liquidity sort of aggregated in one spot. But I'm very much a believer that Bitcoin's going to be around for the long term. And the other thing I'd kind of point out is I think there's going to be increasing desire for Bitcoin access to Bitcoin within DeFi. I think we've had a market that's been very dominated by wrapped Bitcoin and CB BTC, and people are looking for alternatives. And so one of the things we'll work on is providing like a liquid yield bearing version of Bitcoin that can be used across different ecosystems. And then on the final point you mentioned, so I think where can builders get started? I would encourage them to one, go to DAS later in the year. I think that's a good opportunity to kind of meet some of the other builders in the space, and if they want to either join an existing startup team or meet investors, it's really hard to beat just going and meeting people in person. One of the first things we did after COVID was I left Australia and went to the US to start attending the conferences in person and meeting customers, clients, and investors. And I think there's no substitute for that in-person contact.
I guess maybe one last question to that new set. JP Morgan coming out today, a huge softening of what they're going to do with Bitcoin and crypto in terms of supporting it for customers. Do you think the banks are going to give up the rails easily? I've sort of been thinking recently that there's a lot of private blockchain talk again. Do you think we see kind of a second wave of the banks attempting to compete to be the venue where this trade settles still, or do you think we're past that?
Very tough question. I think, look, it's been a remarkable turnaround. What you hear from JP Morgan, right? So Jamie Dimon has gone from calling Bitcoin rat poison to allowing customers to count it in assets when they apply for a home loan, to suggesting that they may do Bitcoin backed lending in future, to recently I saw they just had an announcement today that they can connect Coinbase accounts with with your JP Morgan or your Chase bank account. So I don't think banks will give up the fight easily, but I think banks have a lot of structural challenges when it comes to kind of entering this space. The most pressing or the most pertinent is a lot of them have systems that are now 40 years old. The bank I used to work at in Australia had one that was developed in 1982 and had not been recommissioned since then or replaced since then. And so I think marrying those systems with Bitcoin, a technology that's been developed in in the last 20 years, is going to be very difficult for them. Their systems are twice as old, but probably more importantly, which is lost on a lot of people, capital treatment kind of governs what banks can and can't do. And so Bitcoin is going to get worse capital treatment from Basel, which sets their risk capital requirements. And it just is going to mean it's less profitable for them to do stuff there. It's going to be less profitable for them to lend against Bitcoin. And so I think the market will actually be ceded to specialists. And that's why we have tried to position ourselves as a specialist Bitcoin backed lender within the space. You can kind of already see it with private credit, right? Like banks didn't really want to, but they actually ended up ceding kind of all of private credit to Apollo, Ares, Blackstone, KKR, and now that's a $1.5 trillion industry. And they've JP Morgan had to set up their own private credit team to kind of claw back some of that. But I think crypto stablecoins and Bitcoin is going to be conquered by specialists rather than by these kind of uh, you know polyglot or polyglot banking institutions.
Sid, appreciate the time. Thanks for the thoughts. Maple Finance, where do people find out more?
They can look us up. We are website is maple.finance, or we are on X at Maple Finance, one word, and then I'm on X as at Syrup Sid, one word. So feel free to reach out or look us up, and we try and be pretty active on the social side.
Appreciate the time. Everybody following along at home, if you're watching on YouTube or Rumble, smash that like or subscribe button. As mentioned, Digital Asset Summit heading out to the United Kingdom in London later this year. You can go to blockworks.co, find out more about the great events. Going to be a lot of crypto conversation. I'll be there bringing a Bitcoin perspective. For now, this has been a Supply Shock, a Blockworks podcast.